India's parliament made the Gift Tax Act in 1958 starting April 1, 1958. This law was separate from taxes on income or property and aimed at taxing the transfer of wealth. It stopped applying to gifts made after October 1, 1998 because the Finance Act of 1998 ended it. The law said a gift was when someone willingly gave away their property, movable or immovable, to another person without getting money in return. This covered both direct and indirect ways of giving wealth to prevent people from avoiding tax. The person giving the gift usually had to pay the tax. At first, the tax rates increased as the gift's value went up. But from April 1, 1987, there was a flat tax rate of 30% on all taxable gifts, and a certain amount was tax-free, like the first 30,000 rupees. The law also listed some gifts that were not taxed, such as gifts to the government or charities, gifts to close family members for their wedding, up to a limit, gifts in a will or when someone thought they were dying, and gifts for a child's education. These exceptions were made for social and economic reasons and to focus the tax on bigger gifts. The value of gifts that weren't cash was based on how much they would sell for on the day they were given. The Gift Tax Act of 1958 was stopped on October 1, 1998, mainly because it didn't bring in much tax money, was complicated, and people tried to avoid it. For a while after that, October 1998 to March 2004, gifts were not taxed. Because some people reportedly took advantage of this, new rules for taxing gifts were added to the Income Tax Act in 2005, starting from April 1st. Now, if someone who isn't a close relative gives you gifts worth more than Rs. 50,000 in a year, you have to pay income tax on them. However, gifts from close family members are mostly still not taxed, which is similar to the old policy about family wealth transfers.